Good morning, and thank you for joining us for today's free webinar on how to raise angel money, a guide to raising capital from angel investors, with Deepak Gupta from SeedChange and Sirk Roh from Early Growth Financial Services. My name is Gina Longmire, and I'm the Marketing Manager for Early Growth Financial Services, and I will be your moderator today. This presentation will run about 40 minutes. If you have any questions as we go along, please feel free to enter them in the question field or tweet them to us at Early Growth FS with hashtag Angel Money. Don't raise your hand, just jump right in with your questions. We will answer any questions as they come, and if we can, or we'll wait until the question and answer period at the end of this presentation. If we run out of time, we'll be sure to follow up via email after the presentation to make sure that all of your questions have been answered. You will also receive an email tomorrow with the link to the deck and the recording. I want to start by introducing our presenters. We're very pleased to have with us today Deepak Gupta, Managing Director of SeedChange. Deepak connects startups with customers, partners, and investors to help grow their business. He has expertise in providing startup guidance and hands-on assistance with business model and growth strategy, customer and business development, and marketing. He's also a mentor at 500 Startups, StartX, Vegas Tech Fund, and advisor to several startups. Welcome, Deepak. We also have with us today Sirk Roh. Sirk is the Chief Operating Officer for Early Growth Financial Services. Sirk has 25 plus years of finance experience, with 17 years serving in financial leadership roles with high-tech companies. He's an accomplished finance executive focused on leading early-stage companies through strategic final decisions. Before we dig into the agenda today, I wanted Deepak and Sirk to tell us a little bit about their respective companies. Deepak, could you please say a few words about SeedChange?
Yeah, seedchange is an online platform where we actually help companies raise capital. We're in the middle of actually changing some stuff in the business model itself, but the premise is we're still trying to help companies raise money. So, that's it from a seed side.
Great, thank you so much. And Sirk, can you please say a few words about Early Growth Financial Services?
Yeah, of course. Thank you very much, Gina. Hi, everyone. My name is Sirk Roh. I work with Early Growth Financial Services. We are a national financial and accounting outsourced service company. We work with 400 active clients. Many of them are early stage high-tech companies. And our sweet spot is working with companies that are going through either a seed or Series A financing. We provide four basic types of services. We do tax returns, corporate tax returns. We do 409A valuations for companies that are providing stock options to their employees. Those have to be done on at least an annual basis. We provide transactional accounting and bookkeeping services, including a hard monthly close of and preparation of financial statements. And then we provide higher level or CFO level financial consulting for things like budgeting and financial planning and fundraising and looking at debt versus equity, and then any other type of higher level financial assistance that companies are looking for. And we provide this on an hourly basis as opposed to any kind of a monthly minimum or monthly retainer fee. And so early stage companies that don't have the need for full-time or even half-time folks find us to be a pretty compelling value proposition.
Great, thank you so much. All right, let's go ahead and dig in. Deepak, would you like to kick off the conversation by defining who an angel is?
Absolutely. Well, thank you again for this, Sirk. Good doing this again with you. I'm looking forward to actually going through this and giving you guys a little bit more update on what's going on. But coming back to the basic, what is an angel? What are we looking for in terms of seed investments from an entrepreneur side, and what's going on? Again, an angel is somebody who's obviously well off, but he could be either in tech or finance, high net worth, could be living in a tech hub, whether it's obviously Silicon Valley, but could be DC and other New York, other major cities. Generally well educated, is doing a full-time job or other type of work, but is also a part-time investor. And as an investor, he could be part of an angel group or doesn't have to be, but he's trying to see as many deals through AngelList and other online platforms, and this could range anywhere from 50 to 250 startups a year. Uh, that's about it.
And Deepak, how, what kind of, like, when you talk about it at this level, what kind of investment, amount are these angel investors making for each deal?
Yeah, I mean, they can generally range. I've seen as minimum as 10K, but it could be even, 15, 20, up to 100K. But generally speaking, it's between 10 to 25K.
Great.
So, what kind of companies do angels invest in? Now, this can really vary, but generally speaking, for seed or early stage deals, they can look at clean tech, healthcare, fintech, and obviously any kind of other technology companies such as e-commerce and other verticals. But bottom line is any type of company, early stage startup, it needs to be solving a problem. What they're looking for is a problem being solved, good management team, maybe have IP, doesn't have to be, and then finally some kind of business model. Eventually, how is this startup going to make money?
And Deepak, can you talk a little bit about kind of, like the, like revenue trajectory, or what kind of like hockey stick, potential you would want to see as an angel investor? Because I know that there are certain types of companies that are maybe, slower growing, like maybe perhaps a service company or consulting company that might not appeal as much to angel investors.
Yeah, and this is a great question because early stage companies, everyone obviously wants to see revenue, but at that level you might not see it. So another way we're trying to measure is based on traction and actually user growth, and this would be month over month growth. And generally speaking, you like to see, at least 3 to 6 months, and you like to see at least 15 to 20% growth month over month on users. Having said that, you do need to figure out what is your strategy for generating revenue eventually. After a certain number is how much are you going to do, and what are you looking for from a business model standpoint?
And guys, I don't want to interrupt you, but we do have a quick question in regards to this. The
Sure.
question is from Leo, and it says, is it more common for angels to invest in pre-revenue companies versus VCs?
Angels are definitely more. First thing, VCs. VCs generally look for companies that have good traction, and when they're looking at traction, even accelerators, they're looking at upward of 15,000 users minimum and showing some kind of a growth rate. Having said that, VCs, generally speaking, are writing bigger and bigger checks. Half a million, 750,000. To $1 million. So they definitely are looking for that kind of a hockey stick.
Okay.
So coming back to your question, I think angels are the ones who are actually carrying most of the load early, and they're putting in 10 to 25K per company, and for them it's more about traction. Again, month to month, how are the companies doing?
Okay. And then one last question from Rosaline. Do angels invest in consumer product startups?
Angels do. I mean, you look at consumer startups. Even if you look at their articles from about Uber and Airbnb and other companies that are really big now, but initially when they started, they were all some of the angels actually came in and put money in them. So yes, they do invest in consumers based startups.
Yeah, and I think that, and Deepak could probably speak a little bit more to this too, but one of the experiences that we've seen is that depending on the kind of company you have, the technology, the market that you're going after, right? There's so many different angels, and many of them are focused in certain areas, and it's kind of incumbent upon you to kind of figure out which of the angel investors are more likely to invest in the space that your business is in, and target those guys. The other thing I'll say, and this is a key point. I mean, Deepak already kind of mentioned it, but we really, really stress the traction, right? So, you're not even at an early angel investor or seed financing, this isn't the place to kind of, figure out, what you have or whether you even have a product or not, right? That's the work that you should be doing on your own with your own personal capital, your sweat equity, prior to even going after a seed financing. The more traction you have, the higher the probability that you're going to get investors, whether angels or VCs, interested in your company. You're going to get probably a higher valuation. You're going to be able to, just improve your odds of getting financing dramatically. So we really, really encourage you to get as far along as you can, before you go out and look for financing, because that traction is really what's going to win the road for you.
No, good point, sir. I mean, that's whether when it was, I guess if you go back in time, 98, 99, even 2000, you could probably get away with a pitch deck and just an idea. But times have changed so much now that based on how easy it's to start up with a startup itself, and minimum cash is needed. I think the focus has more on actual traction and how well you're growing the company. The actual idea and the product phase, that's all sweat equity or money from friends and family. And unfortunately, things like that you can't get funding anymore for.
Yep.
Okay, so how do entrepreneurs connect with angels? This is a full-time job, whether we, entrepreneurs like it or not. I mean, you're going to have basically tons of meetings. You're first relying on your network through LinkedIn or whatever, through friends and family, and just trying to meet people. You have to be very persistent. One meeting won't do it. You'll do, later you can see in the objectives, it's going to take at least multiple meetings. You'll get introductions from 100 to 250 investors. You'll meet them, meet at least 50 to 100 of them. Follow up with at least 25 to 75, and then hopefully get a check from 8 to 15. So this is a full-time job. And having said that, this is going to take a lot of resources. This is a sales process, whether an entrepreneur likes it or not.
There's one other point that I want to make too. I mean, I'm sure some of you guys are kind of already in the throes of this thing. You're already kind of starting to network and potentially meet with investors. Others may be at even an earlier stage than that, either idea formation stage or just getting started, and you're kind of trying to understand where things might be months down the line when you're ready to start this process. And I can't stress enough, the earlier you start, the better off you are. Getting an understanding of who the players are. Again, reiterating, which of the angel investors or angel investor groups might be good fits for the kind of company or the product or the service that you have. That's really important, in narrowing down your list so that you know who you're going after. This relying on your network, this is huge, and this is one where I'm going to be a little bit self-serving here. But not only for early growth, but with other kind of companies. Everyone that you're working with, whether it's fellow entrepreneurs, whether it's service providers, and particularly service providers, they should be sources of introductions for you when the time comes. So, when I talk about service providers, we talk about, being kind of in this ecosystem of providing service to early stage companies who are ultimately going to go after financing. But it's the lawyers, it's the bankers, it's the, the HR service providers, the payroll service providers, the the insurance service providers, and obviously accounting professionals. And you should be asking the question as you're working with these partners about not only can they provide the service to you, because most people can do that. Most service providers can provide the service. The question is, are they going to be able to add additional value? And there is no better additional value that a partner or a service provider can provide than making a key introduction for you with potential investors down the line. So absolutely ask the question. And if a banker it doesn't have a ability to make introductions to you when the time comes, then probably not the right banker for you.
And one last question, guys, before we move on. Rosalie wants to know, what's the best way to target angel investors?
I think meetings itself is actually trying to get an introduction from a friend or acquaintance is the best way. But to target angel investors, I think again, if you're in a certain vertical, you need to find out who are those angels who invest in that vertical. For example, e-commerce or mobile Bitcoin or whatever it is, and then try to find introductions to those investors through your contacts. And I think that's the best way to actually target those investors, because a warm introduction will go a longer way than a direct email itself.
Yeah, you need a warm introduction, and I think Deepak is probably being a bit modest here, but obviously the companies and people like Deepak with seedchange is a huge opportunity and a resource that you should be looking at using and leveraging.
Okay, these are some great questions that all angels ask, and I think any entrepreneur should have a I guess answer already set out before they meet an angel. So again, in the product, pretty standard. What's your business about? Why will people use your product? And everyone wants to know eventually, how do you make money? How are you plan to make money? And the second thing is market. We want to see how big is the market, what's your competition, and how are you actually gaining traction? How are you taking customers away from other competitors, or how are you attracting customers in the first place? The team, this is very important, guys. More than the product and the market is the team. Have you guys done this before? If you haven't, how well do you work with each other? Second thing is, who takes care of what? Meaning, is there a technical person on the team? So is that technical person responsible for any kind of inquiry, either from investors or from customers? Same thing, from the business side and sales side. Who is the point person? Risk. Again, what is the biggest problem you need to solve, and why now? Why should an angel investor put money into this? Technology IP, that's self, and then funding. What are you going to use your money for? Well, it's like, all right, I'm trying to raise $1 million, and it's going to last me next 12 months or 18 months. What are the milestones? What are their financial projections? Meaning, what's a burn rate? You might not have revenue, but tell me month over month, how much money are you thinking about using? And finally, it's like, what are your milestones, and how are you going to get to Series A? I mean, these are very important. And then for Series A, you guys already should be thinking about who you need to target for Series A. What kind of VCs you like to attract, and then what are those VCs looking for? Every first round capital or homebrew or any of these early stage VCs, they might be looking for something, but another VC might look for something else. So we need to have a plan right now for the next 18 months. What are we going to do with our money? And B, how are we going to get to Series A?
Those are really, really great points, Deepak. There's a lot of information here, and I just wanted to just kind of add, probably two things. One is on the team. I get asked the question all the time from really early stage companies that says, "Hey, listen, it's just me, right? I'm the founder, I'm the one who's kind of thought of the product and the technology. Is that okay? Do angel investors want a team, or is a single founder okay? And Deepak, I'd like your thoughts on that, but we absolutely encourage there to be at least a two-member co-founding team. It reduces risk on the side of investors. They don't want to invest in one person. Too many things can go wrong. There's just lots of reasons why. But really having, if you have a team of two or three, one person who's really, really the technologist, and then one person who's kind of the business or the sales and marketing focused person that understands the market and how they're going to attract or attack the marketplace. I think that says a lot, to investors that you're already kind of down the line of having put together a team. The second thing that I wanted to mention and reiterate what Deepak just said is just this whole thing about milestones, right? Every financing that you're going through, you should be thinking about what are the milestones that I'm going to meet, because if you think about the valuation of the company, of your company, it's not a linear function, and it's certainly not. It's not going to be a curve, an upward sloping curve either, right? There are step functions that happen, and those step functions and big increases, jumps in valuation happen when you hit milestones, and those milestones are different, for different kinds of companies, but it may be product development, it may be a number of eyeballs, it may be a certain amount of paying customers, or a certain revenue number. Whatever those milestones are, you need to understand what they are and how you're going to get to that next set of milestones that's going to increase the valuation of your company, so that the money that you're getting from this seed round of financing is going to take you to through those next milestones, so that when you go after that Series A financing, then the company has a much greater valuation. Your current angel investors are very, very happy because they've had a step up in their valuation, and we're kind of on the way to success.
I couldn't agree more. I mean, that are some great points. But coming back to the team, I think I think it's very important for most entrepreneurs to have a co-founder, because there's always a risk with a single entrepreneur that what if this person goes, gets a full-time job, or decides he just doesn't want to continue with this idea. So any way you can take risk out from the equation, I think that's important to the company and to the angel investor. Okay, next slide, from questions angels don't ask but should ask. I mean, this is very important, and this is something that all entrepreneurs should think about going into talking to angels. One thing is just not the co-founders liking each other, but also, does the angel investor like you? Does he buy into the vision and the story? So that's a trust factor. And then end of the day, any job we take, I don't care if it's even an engineering job, we have to sell. We have to sell our idea. We have to sell this concept, and we are selling it to the investor. So again, they want to see, can you sell? Can you actually build a team? Are you a thought leader around your idea or startup? Can we work together? This is very important. 6 months from now, a year from now, if the startup is going sideways and you come back for more money, I want monthly updates. I want to know exactly what's going on with the company so I can help you. It's not like, all right, I've gotten the 50K or 100K and I'm on my way as an entrepreneur. I need those updates to the investor. Is anyone else going to invest? I want that security once I give you 10 to 20 or whatever, however much I'm going to give you, that my money is not the only money. And then again, competition, I think that's the key. Non-rational criteria, this can make or break a deal. And I think, again, entrepreneurs should know what they're getting into. Founders, they want to know, do I identify with you? And again, the industry, university experience, what's your background? Is there a way I can relate to you? The product, when Uber came out, no one thought it was a great idea, but it was pretty different. It was pretty unique. So there was definitely a cool factor. And finally, whatever idea that there is, can I relate to that? Is it resolving some kind of personal pain, whether with, home life, kids, whatever, phone? Is there a way I could make that connection? And again, I think the market goes with the product itself. It's that personal experience. I remember working for an e-commerce company, so I know how that's like. And that's my interest. And if there's any way I can relate to the entrepreneur, that's great.
I want to just add on one point, and that's kind of resolving the personal pain. Angel investors and VCs, while they share a lot of similarities and obviously some differences, but angel investors are personal investors, unlike VCs, who are typically taking money from limited partners and other investors and investing it on behalf purely from a financial return perspective. And so, because of that, sometimes you might find yourself in a situation where you just really hit it off with an angel investor. They look at you, they nod their head when you're talking to them about the problem that you're trying to solve. They may have experienced it themselves, and that could actually carry a lot of weight with potential angel investor as opposed to a VC who might ask the really hard questions about returns and market opportunities. Sometimes I've seen angel investors write a check to a company without doing a whole lot of due diligence, just because they really hit it off with the entrepreneur and love the message and love the problem that the entrepreneur was trying to solve, because they've experienced it themselves and they want to be part of the solution.
And this next slide actually talks to this. I mean, we're talking about meetings, it could take up to 6 meetings, but what Sirk was just saying, the first meeting, I love your idea, I love the product, I can relate to you, and boom, here's the check. There's no due diligence, there's no discussion terms. They just have such a strong attraction based on their interests or their likes or whatever. They're like, oh, I need to get into this now, and I here's the money. Having said that, generally it takes about 6 meetings, and you can see the 6 coffees, lunches, whatever you want to call it, and it can vary from meeting to meeting, but generally due diligence would take at least 4 or 5 meetings, and then negotiating terms could take 1 to 2 meetings. But this is usually the case.
Yeah, think of it as long-term dating.
That's right. All right, so finally, this is pretty important, the decision-making process. What's going on inside of an investor? And what should the entrepreneur be thinking about? And again, we've all heard about the elevator pitch. And this is, again, 30 to 60-second pitch, just giving the product overview. Then again, your pitch deck, this could be anything from 10 to 12 slides, and we'll go through that in a later slide deck. Your founder's information, your co-founder, all that information. And then finally, the market and the product. I think we've already discussed this, but again, how big is the market, what's the competition, and again, the product itself. Finally, the team itself, we've gone through this. The team, we need to know what the co-founders are responsible for, what you're responsible for, how many other team members are there. The financials, we talked about milestones. And then the deal, what are the terms? What am I getting for this deal? And finally, the legal, what should I be thinking about from a legal perspective? And then I'm like, okay, here's the check, either 10, 15, or whatever dollar amount.
And as you're going through this, and as investors are going through this decision-making process, obviously lots of questions are going to come up. You may start getting them in initial meetings, but probably more so in due diligence meetings. But you really, as an entrepreneur, you have to know, the market, the product, the opportunity. You have to know it cold, and it's not just the higher level stuff, but it's kind of the nitty-gritty details. They're going to be asking you questions, like, for example, if you have a SaaS model, model or a software as a service model, they're going to want to understand, okay, what is the cost of acquiring a customer, and what do we think the lifetime value of that customer is going to be? How long can we expect them to pay for our services? What kind of churn is there? What are the assumptions that we're putting into the model that we can do as a reference check or as a sanity check to make sure that you're thinking about things properly? The more confident we can feel about that, about those kinds of messages and communications with investors, the more confidence they're going to have that you understand the model, you understand everything that's involved in making this company a success, and obviously is going to increase the probability of you getting money from that investor.
I mean, as an entrepreneur, you guys have to make sure that you're taking in all the risk for the investor. You need to make him feel comfortable that you have thought this product out and you have proven it. You've proven it in a unit model. And unfortunately, getting money today, you need to prove your product and idea, fine. But then you need to just prove that you can scale it, and you need money to scale it further. You're growing your business, on whatever, 10 to 15% a month. And to really accelerate the growth, you're looking for some cash infusion. And fortunately or unfortunately, that's the way an investor looks at it now. He's like, okay, I buy the idea, I buy what the entrepreneur is doing, and I can understand the growth rate. And here's, however much money to accelerate this growth. Finally, the funding pitch guideline. This is a key in actually coming back to that 30 or 60-second pitch, but this could be that 3-minute pitch or whatever it is. And bottom line is, you need to tell a story. Again, you need to tell the story that a investor can relate to. And this story could be anything from 15 to 30 seconds, at the most 45 seconds, something that draws them in, something, you can see these people are sitting right here on the table, but someone might be falling asleep, whatever, and it's like, how do you get their attention when you get on the stage? And a story is the best way. Once you have their attention, then you're actually talking about the problem, the solution, the market size, the model, competition, your IP, and your team. I mean, these are about 10 to 12 slides max. And any other data that you need, you can actually put this in backup in the appendix, because the important part is making sure you can tell this story and get your idea across. And slides are just there in a way to help you guide what's next.
Yeah, the investor is going to be looking for, several things. Again, getting confidence from the team, and one of the ways that we can, hurt ourselves is by trying to convey too much information and trying to put too much information into a pitch deck because you want it to be self-contained. That's not what a pitch deck is. The pitch deck is to get investors excited about the opportunity, have them ask more questions, want to take the due diligence meeting. It's not a place to go into finite detail or infinite detail about everything that about the product and the company. It's going to show, if you try to put too much information into a pitch deck, it's going to send a message to investors that you don't know how to communicate your value proposition succinctly, and that's going to undermine your efforts. There's a few other things that I always say when we talk about pitch decks is, I always say, if you can replace words or bullet points with simple graphics or charts, do it. When you're putting together a financial model, you don't want to put a spreadsheet onto a presentation slide. You want to just kind of show in graphical terms the kind of revenue that you can expect, the revenue growth that you can expect, and what kind of money that you might need to hit those revenue targets. There's different formats that you see. If you look online, you'll see lots and lots and lots of different templates, different types of charts that make sense for different types of communications, whether it's financial, competitive matrices. There's 2 or 3 different ways of showing that. Do that when possible, and replace words with charts and graphics. The other final thing that I always that I always kind of recommend to co-founding teams is, let the best pitcher pitch. right? You may be the actual founder, you may be the one with a product idea, and you may be the technologist. A lot of engineers, start up companies, and they understand the technology, they understand the problem they're trying to solve. But you may not necessarily be the best presenter, you may not be the best salesperson for your company. Just because you're the founder and the CEO doesn't necessarily mean that you're the one who actually has to pitch it. You should be going in as a team, let the best pitcher pitch. You'll be presenting as a team, but if there's a sales and marketing or a business person who's really, really good at it, even though he's not the initial founder, let him or her do it.
Exactly. I mean, the bottom line is the pitch should be something that's there in a way to sell the idea, sell the product. They're relying on the team itself. It's not just you. All right. This is a loaded question on valuation. And every year, every 6 months, it's changing. Unfortunately, right now, fortunately, again, it's a great time to raise money, and valuations are too high, in my opinion, but that's a different topic. What is the valuation on my startup? And, seed and early companies, it comes down to traction. It comes down to traction. It also comes down to where you're based out of. Are you based out of Chicago, based out of New York, based out of here? Because investors are going to look at comps and they're going to say, okay, these types of companies or these type of seed investments are going for this kind of valuation. Finally, entrepreneurs, we can ask whatever we want, but investors are going to decide at the end of the day what they're comfortable with, and they'll counter. And then it's up to entrepreneurs to decide one way or the other. Generally speaking, I've seen valuations anywhere from 3 million and higher in the Valley. And, if you're coming out of, again, one of those Y Combinators or accelerators, those valuations could be $8 to $10 million.
I get asked this question all the time too, from clients and entrepreneurs. And one of the things that I try to say is, look, you got to look at it from several different perspectives, I think. And to the extent that you got these 3 or 4 things that kind of all point in one direction, I think that'll at least give you kind of a ballpark. And the 3 things that I think about are obviously the valuation, but dilution too, right? And when I say dilution, it basically means that, okay, investors are going to put in some amount of money, and for that they're going to get a certain percentage of the company, and therefore you're going to get diluted. Now, an investor, and Deepak, I certainly appreciate your feedback on this too, but I think there's kind of like a range that you want to shoot for, right? In typical seed financing, maybe a 20 to 30% dilution is appropriate. And so, if you think about how much money you're trying to raise, and then you compare that with kind of what you think an appropriate valuation might be, and then the third piece of that is kind of the runway, right? Or how much cash you're looking to raise and how far it's going to get you, going back to that whole milestone thing. But really, you're looking at cash to take you to probably 12 to 18 months of runway, so that you can get some milestones knocked off before you go after a seed. So if you think about it in those 3 perspectives, so valuation, dilution, or how much money you need for a 12 to 18-month runway, I think that you've got kind of 3 different factors that hopefully can, you can kind of massage into what you think might be an appropriate valuation, at least to start discussions with.
Yeah, and from a seed perspective itself, I tell most entrepreneurs, do it as a convertible note. Don't worry about dilution, and especially, I mean, in terms of actually raising money and trying to get money in, the cap could be always have a cap, whether it's 4 million, 5 million, 6 million, because the actual valuation is going to be determined when you do a Series A. And I agree 100% with Sirk. I mean, usually it's 20 to 30% what the investor would take in Series A, and that valuation could then be set to whatever number it is. But right now, think of it as a convertible note, and what's the cap on the convertible note in seed stage?
And quick question, guys, before we move on from Marie. She says she has a product that is sold worldwide, but not yet in the United States. It shortly expanded to the US. How would you come to that kind of valuation for the United States launch of the product? Do you need me to
Well,
repeat it? Oh, go ahead.
yeah, no. I certainly heard it. Yeah, I'm sure we're kind of thinking about it, but it really, I'm not so sure that there is any kind of like a specific analysis you would do, U.S. versus other. I think it's just kind of that entire financial model. Again, the opportunity. Obviously, the U.S. market presents a certain market opportunity that you're trying to attack and win. And to the extent that you can provide support to be able to say this is the kind of revenue that I expect to get by coming into the United States, it's really about that revenue growth trajectory, traction number that is going to attract the investors, and the valuation is going to be dependent on all those different factors, not necessarily just because it's U.S. versus other part of the country, other part of the world. Granted, U.S., presents a big market, potential market for people coming in, but it still comes down to what the numbers say and what investors think about what the potential is from a revenue and traction and ultimately profitability standpoint.
Awesome.
Yeah,
Thank
I
you.
agree. I mean,
Oh,
in
go ahead.
terms of the investor itself, I think are you targeting investors outside of US or within US? And if it's within US, you have to definitely look at what the revenue model will look like in the US and how fast you're going to attract customers. Majority of the investors, or a lot of the investors in the Bay Area, would like to do US first and then outside the US. Again, at a seed stage, they just want to prove the business model. But in this case, since you already have revenue outside of the US, you want to make sure what the traction would look like inside, within US, and kind of sell that.
Great. And then just a couple more. One question from Leo is, can you share the emerging interest in convertible notes as a tool to address the valuation question? What's the general sentiment towards convertible notes with favorable terms?
I think if you have favorable terms, it's definitely easier to raise right now because there is a lot of money out there. There's money out there from angels, whether they're, uh, post guys from Facebook or Google or whatever. They're looking to put their money to work. So if the terms are favorable, I think that's in the investor benefit and your benefit because you can raise money fast and go back to the product and actual design and traction. From a valuation standpoint, since you're not setting up the valuation right now, or the cap could change. Cap could be a $3 million cap. I would tell you not to give too much emphasis on the valuation or the cap at this point. I would try to keep it as such that you want to show a trajectory that's northward, meaning that the next round needs to be higher than this round. You definitely never want to do a down round because it looks bad at the company as well as the investors who have already invested.
Great. And then Raphael, to kind of piggyback on that, has a question from a very recent blog. Mark Sester from Both Sides of the Table and partner at Upfront Ventures recommended against convertible notes for seed stages. What are your arguments for convertible notes aside from its cheaper counterpart?
Yeah, I know Mark actually, and I was surprised he said that because right now I think there's just so much cash out there that people are saying might as well do equity round and understand what's going on. But again, looking at it from an entrepreneur perspective, I think you're giving too much of the company away at seed stage, and there could be a lot of more value that could be earned later on, that doing convertible notes is a safer bet. And most of the accelerators you see, most of the other startups, even outside the valley, prefer convertible notes than actually doing a price round. But having said that, if you are a serial entrepreneur and you've done this before or you have a track record, then of course, if you can do a price round, go for it.
And final question, what percent would a 2 million convertible note be worth with capped valuation of 8 million? Is that calculated as a pre or post money valuation?
I'm sorry, can you repeat that?
Of course. What equity percentage would a $2 million convertible note be worth with a capped valuation of 8 million? Is that calculated as a pre or post money valuation?
The 8 million would be a post money valuation. Or see, again, in convertible notes, you don't have a pre or post, right? So you're just capping something at 8 million itself.
And then one final question, are the expectations regarding return multiples and potential exit value different for angels versus VCs? Will angels and or VCs still be interested if you don't have a clear path to a billion-dollar company?
That's that's a loaded question as well, because I think every angel investor wants to invest in something that's going to give them at least 10x returns. I mean, this is from a startup perspective, this is a very highly risky uh, proposition. Having said that, not every company is going to be a billion-dollar company. So, it depends from a angel to angel. Again, if a angel buys into the company and has a good rapport and understands the product and understand what you're going after, he might be okay with a 5x or 10x return. Again, it might not be $1 billion, but enough that he feels like, okay, I trust the entrepreneur and there's something here. Again, there's just so many startups out there that are trying to raise. It's like, how do you differentiate? How do you actually make something that an angel gets excited about?
Right. And then
Yeah,
another question. Oh, go ahead, Sirk. I'm sorry.
no, yeah, I think, all investors, at for private companies are looking for that kind of that 10x, right? And so the amounts are obviously different for angel investors versus VCs. VCs coming a little bit later. There's a little bit less risk. There's more traction, but they're also putting in a lot more money, and enabling you to grow at a later stage. So, but I think for you still have to show, obviously, at some point, that the hockey stick that's going to really skyrocket the valuation of your company, such that even the early stage investors see the potential for big returns down the line.
And then another question is, do angels prefer to invest in C corps versus LLCs or closed corporations?
Oh, definitely C corps and Delaware Cs, please, because Delaware laws are such they're most favorable to investors. LLC, and there's more liability issues. So C corp.
Yeah, it has to be a C corp, and maybe not at the stage when you're getting a convertible note, but certainly by the time you're getting an equity financing, and you're going to have multiple classes of stock, you're going to want to be a C corp. And I concur with Deepak that there's no reason why you wouldn't want to be a Delaware C corp as opposed to a California or some other state. Delaware makes it too easy, less expensive. Just there's no downsides to being a Delaware C corp.
Yeah, and you don't want to go through the hassle if you're LLC or whatever that you need to convert, in Series A. It's just more cash out of the pocket. So if you want to convert cash, just start it the right way.
Agreed, agreed. Absolutely. If you know that you're a company that's going to ultimately go after outside financing, you should set up as a Delaware C Corp from day one.
How about closed corporations?
Yeah, I would stay away from those two. C Corp is the safest bet. I mean, you guys can go to there are tons of startup blogs that give legal advice and how should companies be set up, but C corps, Delaware C are the safest.
Great. Well, thank you guys so much, and thank you all for joining us. This now brings us to the end of our webinar. We very much appreciate your time and hope you found this useful. If you have any follow-up questions, please feel free to contact us using the contact info provided here or tweet to @earlygrowthfs #AngelMoney. If you're interested, our next webinar is tomorrow from 10 to 11, Going Beyond the Pitch Deck, a practical guide for startup funding with Peter Mansfield from Mansfield Associates. And you can check out any other events at our events page at www.earlygrowthfinancialservices.com. That's www.earlygrowthfinancialservices.com to register for this webinar and many others. We hope to connect with you again soon. And thank you again to Deepak and Sirk for a great presentation and to all of you for attending. We hope you have a wonderful day.
Thank you, everyone, and best of luck with all of your efforts and fundraising activities. We know it's hard work. Just keep it going.
Likewise, I can't agree more with Sirk, but it is hard work. But good luck, everyone, and thank you so much.
Thank you.